looking at the market yesterday, as we say, looking at a new 9-month high, and it's very much been a case of broad-based buying into the market, and it looks like it's not just the big caps that are driving the NSE higher. What are your thoughts on that?
That's exactly right. The rally was a very narrow based rally at the beginning of the year. It was the big cap stocks, EABL, KCB, BAT, but breadth continues to improve, and we've seen a number of the smaller counters beginning to participate in the rally as well. Limuru Tea, I know it's a little bit esoteric, but that hit an all-time high last week. We've seen the whole move broaden out. I'm reasonably constructive. I think we've had half the year's gain so far. The market's up about 15+%. I think we'll end up plus 30. Admittedly, we were starting off an egregiously low base after the sell-off when interest rates were hiked at the back end of last year. But it looks constructive to me, Samantha. Continues to build momentum.
There's so many stocks that we're watching in terms of hitting fresh highs. Of course, Chumi is one of them, and British American Tobacco is another one of them. Continues to hit a succession of 2012 highs. As I was saying, it's very much been a dividend play, but on a fundamental basis, what are the prospects for BAT?
Well, you're completely right. They pay out about 98.5% of their earnings per share in dividend. So it's been typically traded against the government bond curve. People have looked at the yield, it's been high and handsome. But you know, they accelerated full year earnings last year by about 74%. And what they've done was increased, as you said, production, and there was a significant acceleration in the profit report. So I think investors have got the dividend to lean against, and they're being sprinkled with a little bit of growth, and that's proven a very attractive mix. We've seen it rally about 46% in 2012 when you include the final dividend, and it's on a PE of about 10.7, which means it's still inexpensive.
So the rally still has legs, basically?
I think so, yes. Yeah. I mean, you know, they are, with BAT, I definitely think so.
Yeah. Let's move on to KenGen and Kenya Power, because two stocks that have been underperforming in 2012. Why are investors so wary about putting their money into these two battered stocks?
That's an interesting question. Both have been, I think KenGen's up about 1% in 2012. I think KPLC's flat or down a little bit. I think in both cases, with KenGen, there is a massive scaling up going on. Equity investors are a bit wary of the debt load. I think, you know, it's an attractive share. It's really a cost plus business. But you know, there is a lot of debt being layered onto the balance sheet, and I think that's made equity holders a little bit nervous. Kenya Power, I think, you know, they're just not making their case strongly enough. People can't get the facts, you know, that we have got rampant power cuts, and I think that sort of contaminates the investor mood about that share price. Both of them look cheap, but I think management need to really come out and make the case much more aggressively in order to get these share prices moving.
As you say, both of them look cheap. If you were a value investor right now and you're looking with a long-term horizon, of course, KenGen has a lot of plans on the horizon to increase production going forward. Would you be looking at these stocks and saying, yes, they are offering good value right now, maybe a time to take a longer-term horizon?
I would definitely be looking at KenGen in that way. I think KenGen has laid out its 5-year plan. I like what I see, and I think, you know, there isn't that much supply at these sorts of lows. So I would be accumulating it. You know, the Nairobi Securities Exchange, you can't just wander in, buy what you want over 24 hours and wander out again. You've got to be persistent. You've got to work at your positions. KenGen is a good example of that.
In terms of some of the other stocks, as I said, Scan Group is one of the stocks that is continuing to drive higher. It's a case of buying into the increased media spend in Africa, and of course their blue chip customers. Has anything fundamentally changed at Scan Group this year to push it to new heights?
Well, I think, you know, the expansion phase now is moving into West Africa. There's a greenfield operation being opened imminently in Nigeria. Mozambique, Angola are both very much in view now. And I think investors continue to like what they see at Scan Group. It's essentially a very similar play to WPP. WPP is the majority, well, it has about 37%, and I am sure is looking to go into majority position on this share. So I think, you know, geographical expansion, a very strong story, already a predominant position in sub-Saharan Africa, and I think it's got plenty of legs. I see it sort of giving a return of about 100% over 24 months from here.
That's a strong return if you're able to get your hands on that stock. Let's shift focus.
That's the biggest problem.
Yeah, that is the biggest problem, as you're saying, with the Nairobi Stock Exchange. You can't just go in there and pick any stock you want right now. Let's shift focus to the fixed income market. Aly-Khan, what are your views on the 5-year bond auction coming up tomorrow and the yields we're going to see? Because many saying that we could see yields falling by as much as 200 basis points. Are you looking at a situation where yields are going to come back quite dramatically on this longer dated paper?
Absolutely. The market is starving for longer duration paper. The central bank have been quite clever. You know, they haven't sold long dated paper for some time. 5-year paper is not long dated anyway. But I think the market has a big appetite for this kind of extended duration. And I think we'll have a big move here as well. I'm not so sure offshore players are going to chase these yields. They've come down dramatically. But onshore players essentially are short of fixed income paper with some duration on it. And I expect to see them come in and this issue to be well oversubscribed.
One of the factors that is making the market a little bit nervous right now is, of course, the shilling sitting above the 85 level mark. And yesterday we were saying, is 84 become the floor? And it looks like, what if 85 then becomes the next floor? What does this mean right now for the market? Because how much firepower does the central bank have to continue to come into the market and defend the currency?
Well, I think, you know, the charts tell me that we're going to go to 85.50. In the scheme of things, given the volatility we saw last year, which was enormous, as you might recall, this move from the highs of 83 to 85, 85.50 is not that dramatic. I think it's just people have got a little bit excited about it. I think the shilling looks okay to me. I think the $600 million loan, not all of which has been dispersed, and a number of things have tipped the balance, and the shilling is not a no-brainer sale at this level, although interest rates have come down so dramatically. So I, for one, think it's okay. The oil price is the big wild card. Oil prices have come a lot lower. I think they're bottoming out here, but that's given us some respite. You know, the 10%, 12% correction saves us a lot of money on a month-to-month basis and is a key driver of the shilling.